Here's something that surprises people. Even a carefully researched, professionally selected portfolio will almost always have at least one or two funds that underperform. Not because something went wrong, because that's how the process is designed to work. Most investors, even sophisticated ones, judge a portfolio one scheme at a time. If they check their statement and see one fund lagging its benchmark, the instinct is to assume a mistake was made. Wrong fund, wrong manager, wrong selection process. So the natural next move is to exit that one fund and chase whatever looks better right now. It feels logical, but it's based on a misunderstanding of what a selection process is actually trying to achieve. And reacting this way can quietly do more damage than the underperformance itself. Let's start with a number that makes this click. Historically, industry data shows that in any given year, roughly a third of actively managed equity funds underperform their benchmark. That's illustrative, based on past data, and it moves year to year, but the pattern is consistent enough to matter. A third. Not one bad manager, not one bad year for one scheme. A structural feature of how active management works across the whole industry. Now think about what that means for a basket of, say, 14 carefully selected funds. Even if a rigorous process manages to meaningfully reduce that industry-wide underperformance rate by filtering for size, track record, and a set of forward-looking quantitative and qualitative checks, it's not realistic to expect it to reduce that rate to zero. Bring it down? Yes. Eliminate it? No. So a well-constructed basket can still reasonably be expected to end up with 2 or 3 schemes that underperform in a given period. That's not the process failing. That's the process working exactly as designed, at the level it was designed to work at. Which brings us to the sub-question that actually matters. What level is the process designed to work at? Not the individual scheme. The basket. A selection process isn't trying to guarantee that every single fund it picks will beat its benchmark every year. That standard doesn't exist anywhere in investing. No process, however good, can hit it, because it would require predicting the future with certainty. What a good process is trying to do instead is stack the odds at the portfolio level. It's trying to make sure that across the whole basket, the winners outweigh the laggards by enough to produce a meaningful net outperformance, even after accounting for the 2 or 3 components that don't come through. That's why looking at a single underperforming line item in isolation and treating it as proof the whole approach is broken is the wrong lens. The right question is not, is every fund beating its benchmark? The right question is the basket, taken together, doing what it was built to do? There's a second layer here worth understanding. Which 2 or 3 funds underperform in a given year isn't fixed or predictable in advance. If it were, a good process would simply never select those funds in the first place. Different schemes go through weak stretches at different times for different reasons. A stock call that didn't play out, a sector rotation that moved against the fund, a size constraint temporarily limiting flexibility. Reacting to whichever fund happens to be underperforming this year by pulling out of it doesn't remove the risk of underperformance from the portfolio. It just means chasing performance after the fact, usually exiting right before a fund's normal cycle turns, and rotating into whatever looks strong today, which carries exactly the same risk of eventually underperforming too. This is also why patience, paired with periodic review, matters more than reflexive reaction. Ongoing review has a real job, distinguishing genuine, sustained underperformance that calls for a change from normal short-term noise that doesn't. But that distinction requires looking at the data with a process, not reacting to a single bad quarter or a single red number on a statement. Imagine a basket of 14 funds. In a strong year, say 10 of them beat their benchmark by a solid margin, while 4 lag behind. On paper, that looks like 4 failures. But if the basket as a whole still delivers a meaningful outperformance over the benchmark once you average across all 14, weighted by how much is invested in each, then the basket has done its job. The 4 laggards were priced into the expectation from the start. They weren't a surprise. They were, statistically, always going to be there in some form. This is a simplified illustration to explain the concept, not a projection of actual results. Next time you look at a multi-fund portfolio and spot one scheme lagging, resist the urge to judge the whole strategy by that one line. Ask instead, how is the basket doing overall, relative to what it was built to achieve? That's the number that actually tells you whether the process is working. That's it for this one. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.